after grasping the concept that I'm about to show you, you will look at things much differently. Everything from how you save your money, how you spend it, how you plan for retirement, how you invest, etc. Now let me start by sharing a little of my background. I have nearly 10 years of experience in the insurance and financial services industry. I sold insurance products, such as annuities, and various investment products, such as mutual funds. And after doing the research, especially on the mutual funds, I've learned that these are not performing for the American people, and they've never truly worked for the American people. I want to explain this more, but I'm going to do so underneath two basic headings. Heading number 1 will be the history of the stock market and the economy, and number 2, the opportunity that exists within creating your own banking system. Now, let's begin with the history of the stock market and the economy. I've received the following data from a good friend of mine, Chase Chandler, and he's also a specialist within this personal banking concept. But the history of the stock market can be divided into 3 main eras of time, and I'm going to show you the data from the Dow Jones Index. The first era is from 1901 to 1979. During this era, the Dow Jones Index experienced a true rate of return of 3.7%. The second era is from 1980 to 1999, and the true rate of return during this era is 14.01%. The last era is from the year 2000 until 2011. Within this era, the true rate of return was less than 1%. The second era, from 1980 until 1999, was the highest because that's when everybody started entering the stock market. You see, in 1980, Congress first started the 401k plan. The IRA was instituted a little before this, born out of the ERISA Act of 1978, and the IRA became available to everybody in 1980. So, during the second market era, we have the majority of working Americans pouring most of their retirement savings into the stock market through IRAs, 401ks, 403bs, etc. Now, the reason this is significant is because in 1950, less than 2% of all working Americans owned a common stock. Less than 2%. So when you look at the large influx of money into the market, it is no wonder as to why it started to go up. This is also the reason why many baby boomers still believe in the market. Even though this third era performed rather poorly, they still remember the second era and believe that's what the market will eventually go back to. Now, when most financial experts talk about the stock market and they are sitting down with their clients to plan for the future, they say that you may be able to get an average of 12% over the next 30 years. So they come up with a plan and say if you contribute so many dollars a month and dollar cost average into your 401k, you will have, say, $1.5 million by the time you're 65. The problem that we're seeing today is that there are many people who have reached the age that they had planned on retiring at, and their finances are only around, say, $300,000 instead. What's going on here? Well, what's going on is that they are looking at the average rate of return for those mutual funds and not the true rate of return that I mentioned earlier. Allow me to be blunt on this. The average rate of return is a lie. It's not real. Many advisors do not know this, but let me show you what I mean. If you have $100,000 and you have a 50% increase in year 1, how much money do you have? $150,000, right? Well, if you have a 50% decrease in year 2, how much do you have then? If you were to say $100,000, I would encourage you to take this more slowly. You actually have $75,000. If you remember the original $100,000 we started with, it increased by 50% in year 1, and we had $150,000. In year 2, this $150,000 decreased by 50%, and we then had $75,000. Now, if we were to look at what our average rate of return is on this money, we would have experienced a 0% average rate of return. But wait, we lost $25,000 or 25% over 2 years. This is exactly why the average rate of return is nonsense. The number that you will want to look at is the true rate of return, also known as the compound annual growth rate, or the CAGR. If we look at the past 2 years in our example and apply our CAGR for a true rate of return, we learn that we had a negative 12.5% CAGR each year, which is equivalent to a negative 25%. Now, grasping this concept is absolutely critical. This is the exact reason why the baby boomers are waking up today and looking at their retirement accounts and wondering, where is all my money? This is where it gets interesting. Even though the stock market has earned an approximate average rate of return of 7.5% or so since its inception, the true rate of return from 1901 to 2011 was only 5.06%. And when you consider in taxes and fees, this number quickly gets reduced to 3%. Now we are at the heart of the problem. A 3% return is much different than a 7.5% return. Now, from what any investor can examine from the market, we all know how it moves. It moves up, down, sideways, etc. If you can see this visually and compare it to an exponential yield curve, you learn an important principle that you must grasp for cash flow banking, and it's this. The biggest inhibitor of building long-term wealth is interrupting compound interest. Let me say that again, because if you fail to grasp this, the entire concept will not make sense. The biggest inhibitor of building long-term wealth is interrupting compound interest. If you can grasp this and other concepts that I will be putting forth, you will know more than 99% of all insurance agents and financial advisors. Okay, let's look at the last of the three eras now. As we do, it's important to note that all markets strive towards equilibrium. That's just what they do. It's their job. Our markets right now are vastly overvalued. They are trying to seek a large correction, but our monetary policy will not let them. In 2008, they really tried to correct, but due to quantitative easing, we are not letting them. We are in the midst of the largest monetary experiment in history, and it has never worked. So the markets are extremely overvalued, and by printing more money, we are going to continue to see inflation at work. Asset prices will go higher than the reported consumer price index, and it's going to be harder and harder to grow wealth, especially if you have a mutual fund earning a true rate of return of 3%, while inflation is at 5 or 6%. Now, I want to talk to you about some banking principles at this point. These principles are important to grasp because we will need to understand how they work in order to implement them within our own conceptual banking system. The first banking principle is leverage. And when you think of leverage, I don't want you to think about debt. I want you to think about using someone else's money to build your wealth. We see banks do this all the time as they lend out the money of their depositors, money that isn't theirs, to various borrowers. The bank will pay out a small amount of interest to the depositor and collect a larger amount of interest from the borrower. This is the principle of leverage. The second banking principle is velocity. And with velocity, the question that I want to ask is, how fast are you moving your money? Because the faster you can move your money, the greater you will be able to grow your wealth. Banks implement this through the number of bank loans they lend out. If they can take the money that they are receiving from their depositors and even their borrowers and loan it out just as fast, they will receive a higher and higher return on their money as it is working for them in many places at once. The third banking principle is cash flow. And with cash flow, I want you to think about a payment system. When banks have many borrowers, they have many streams of payments coming into them. And the more cash flow that they have, the more loans they can lend out to increase their cash flow at an even greater amount. Okay, so now that you have a grasp on these banking principles, keep them in mind as we will need to apply them to our personal banking system a little later. Now I want to dive into how the cash flow banking system works. In doing so, there's an example that I want to use as an intro that will help illustrate how powerful this system really is. Again, I heard this from my good friend Chase Chandler when it comes to cash flow banking. This example compares the legacies of two men, Cornelius Vanderbilt and Amschel Rothschild. Let's start with Vanderbilt. He was basically the Bill Gates of his time. He built much of the transportation system in the United States, and he was a very wealthy individual. He died in 1877, and he left his family with $104 million. Now it's interesting, but in 1972, they had their first family reunion, and he had 120 descendants who were alive. Of these descendants, there was not one single millionaire left. Now compare this to Rothschild. He passed away in 1812, and he made his money in the banking industry. When he passed away, he left behind a family banking system with 3 rules. And in describing these rules, it's important to note that this was a conceptual family banking system and not an actual chartered bank. So the first rule for this family bank was that if you needed money, you would take out a loan and pay it back with interest. The second rule is that the knowledge gained for any business venture had to be shared with the other members of the family. So you had to write down and share your wisdom of what you had learned with both your immediate and extended family members. The third rule was that the entire family had to meet once a year in order to re-establish their family values and their principles. Okay, time for a question. From Rothschild's descendants, how many millionaires do you think are left from his dynasty today? Answer: all of them. Now I hesitate to esteem that, as I do not want to create a type of greedy person who only thinks about money, but I strongly feel that implementing these principles can help you and your family create a powerful dynasty of stewards and would create an immense resilience against the economic bubbles that exist all around us. So as we examine this illustration, it's easy to see that most financial understanding today is done like the Vanderbilt family and not like the Rothschilds. Okay, let's now take some time and examine our conceptual banking system. As with any system, there are rules that need to be applied in order for it to flourish. When you take a loan out, just like the Rothschilds did, you have to pay it back with interest. This will cause the money in the banking system to increase, as well as the compound interest that it's earning. Now remember, I cannot say this enough, we are not talking about becoming an actual institutional bank. You simply want to incorporate these banking principles into your family bank and essentially imitate the Rothschilds. This concept is 90% education and 10% product. Now, as your bank becomes capitalized, we need to remember that this is simply a holding tank for our money. I cannot stress this enough. It's where your dollars live when they're not working for you somewhere else. And as your money is housed in this holding tank, it's your goal to find cash flow assets as investment opportunities where your money can earn better returns. There are many ways to do this, and some like real estate. So let's say that you capitalize your bank and you eventually decide to purchase a vacation condo. And as a side note, many people who are younger may be thinking that it would take a really long time to build up enough capital in your bank in order to buy a vacation condo on a winter ski resort or a nice lake for a summer rental. And while I would agree with this, I would respond to it in two different ways. First of all, the real estate bubble 2.0 is here, and when the next crisis hits and credit contracts as it did in 2008, there will be many affordable deals available to scoop up, and you would be surprised how affordable some vacation properties will be. Secondly, what if you started a family bank with your siblings, your parents, your aunts or uncles? If you would treat this as a family bank and even a family business, you would be surprised how quickly the funds within this bank will grow, just like the Rothschild family bank did. Okay, let's keep going. Now, even though you can and should borrow from your banking system for vacations, college tuition, vehicles, and other items, the concept works the best with cash flow assets, and your goal is to buy an asset with this holding tank of money and try to earn a higher rate of interest on these assets. Then, where you create more wealth is when these loans are paid off and you have an increase in cash flow coming in, and the size of your family bank continues to increase in value and creates a huge snowball effect. Now, I personally like real estate during these interesting economic times, and this would work well with both inflation and deflation. If you watch our first lesson on the economy with Richard Duncan, he points out that one could raise rents during inflation and decrease them during deflation, since things wouldn't cost as much during a deflationary period. It is a rational and somewhat safe strategy. Okay, so as far as I have studied, there are two main reasons to do this. And the first one is obvious: to build wealth for you and your family. Secondly, and this is a tad more complex, this can be seen as a grassroots effort to destroy the inflation problem. If you'd like to further your education on this, there is a great resource that you can purchase at bankingwithlifedvd.com. It tells us about the two major contributors to inflation today. The first one is somewhat obvious, and it's the Federal Reserve printing money. But the second one is actually a larger problem, and not too many people are aware of it. It's called fractional reserve lending, and it's the process by which banks create money through loans. The idea is that they can loan out up to 90% of the money their customers deposit in their banks. So if someone puts, say, $10,000 in a bank, they can loan out $9,000 of that money and earn interest on it. When their customer goes out and purchases a car, say from the person down the street, the seller can go and deposit that $9,000 back into the bank, and then the bank will go ahead and lend 90% of that deposit out, which is $8,100. This process will continue and continue until this initial $10,000 deposit creates a staggering $100,000. This is real money, and whenever there is an increase in the money supply and more units of currency that chase after a limited number of goods, the prices of these goods go up. This is inflation. Okay, let's get really specific now. If we create this holding tank of money for our family bank, there are some characteristics that it has to have. First of all, it has to be safe. The money has to be highly liquid. There shouldn't be any penalties to access this money. There should be tax advantages, guaranteed growth, and we should have some sort of confidence to know that even if the stock markets crash again, as they did in 2008, that we would not lose any money. Now, where can we find this tool? Would a mutual fund qualify? No. A CD or an IRA? Or what about a 401k? They would not qualify either. Now, the true rate of return that our family bank will earn if it's structured properly is around 4.5%. This money grows differently than any other asset. The most efficient vehicle to use in this situation is a specifically designed cash value life insurance policy. And this is not just any type of policy. It's not a traditional whole life contract, and it's not a traditional universal life contract. It is most specifically what is called a low commission, high cash value whole life insurance policy. This is not something that many people have heard about. Again, it's a low commission, high cash value plan. And I would go so far as to say that 95% of all insurance agents and financial advisors are not aware of these plans or how they work. You see, the banks approached the insurance companies in the early 1980s, and they said they really liked the whole life insurance plan, except that the agents made a lot of money in commissions on it. And traditionally, these commissions are pretty high, but that doesn't negate how valuable these policies are, as these were all that were available at that time. Now, you can pass the death benefit amount to your beneficiaries tax-free, but the bankers didn't want to pay these large commissions. So the life industry came back to them and said that they would reduce the commissions by about 80%, and in turn, the bankers could only have access to about 80% of their money in the first year. Well, the bankers love this, and while there are many reasons as to why this hasn't taken off in the mainstream today, I feel that the most prominent is this. People today are not taught to think long term. The bankers who approached the life insurance industry, on the other hand, were capable of thinking long term, and they loved this, because they knew that over a long period of time, their money would grow, and it would grow safely. In many banks, BALI, or bank-owned life insurance, is where they place their Tier 1 capital. And Tier 1 capital is just one of the gauges that they use to show how safe and healthy their bank is. This is true of JP Morgan Chase, Bank of America, and other major banks all over the world, because banks are the largest purchasers of cash value life insurance. Now, I do specialize in structuring and setting up these plans. In the 1980s, many of the super rich and many of the banks were using these policies to invest a bunch of cash into, and they were taking a loan out against the policy right away and investing in real estate companies. So the government knew that if they turned this into a long-term asset, it wouldn't pay off as much for the investors because we live in an instant gratification society. Today, when we set up these plans, we only have access to about 60% of the capital in the early years. So we're giving up some liquidity early on, but if we look long term, we're looking at a historic 5 to 6% true rate of return over the next 30 years. Now remember, and this is important, in the big picture, while these returns are great, we are not really too concerned about them. Remember, our primary concern is that this family bank serves as a holding place for our money where we are going to earn a safe and secure return and then use this money to take advantage of cash flow assets and replenish our bank for us and provide us with larger returns elsewhere. Now, I will be providing specific analysis using specific numbers in future lessons, but it's important to restate that your money grows on a compound interest basis and it cannot go down over time. This is guaranteed. And it's important to note that these guarantees have beat the market for the last 50 years. Now, it's also important to note, if you are interested in moving forward with this concept, that there are a few final items that you should be aware of. First of all, you should only do business with a mutual company. I will provide contacts in my Rolodex of people who can provide these for you besides myself, but let's briefly talk about this importance right now. If you do business with a mutual company, you end up becoming a part owner of that company. You will be given voting rights for annual meetings if you would so choose to attend, and you will receive a share of the profits of the company in the form of dividends. Now, through various economic crises, world wars, the Great Depression, and the crash of 2008, the majority of mutual companies have never missed a year where they haven't paid a dividend. They are profitable, and they share these profits with their policyholders. Publicly traded companies, or stock companies, on the other hand, are not often very profitable. The reason for this is because they are often forced to take unhealthy risks due to their clients demanding higher returns, and this usually ends up with a poor performing portfolio. Now, when you're comparing 3% to 6% interest within a policy for a mutual company, I want to point out that while this is important, it's not the most essential point to focus on. Remember, this is just a housing vehicle for our money, where we will be looking for deals to earn 20 or 30% somewhere else. Remember this. This is simply where our dollars are going to sleep. Secondly, if you do go with a mutual company, it's important to talk to a professional who has set these plans up before and has experience with them. There are ways to improperly structure the policy from day one, which will cause problems down the road in regards to cash accumulation. Try to remember this. This is very important. Number 3, the guarantees given by the mutual companies have beat the market for the last 50 years. Now, it's not my goal to compare the whole life policy to other investment vehicles, because if we're truly going to apply the conceptual family banking principles and treat it as a holding place for our money, we would be missing the point in comparing it to other vehicles. But if we did want to go down that path, it still wins, and they have guarantees. Most advisors do not know about this, and those who do tend to shy away from it, as it results in a large commission cut for them as opposed to mutual funds and other financial vehicles. So when you compare this to the market and you take into consideration the compound growth and tax-free nature of the banking system, you would have to earn an average return between 9 and 10% in the market to equal your life policy. But remember, we do not care about average returns. We are interested in the compound annual growth rate, and there is a huge difference. Number 4, it's important to note that you can create this banking system all by yourself. But if you really want to see it grow quickly, I like the principles that the Rothschild family have adopted in order to make a personal banking system into a family banking system. So if you have a few like-minded siblings, uncles, aunts, etc., who can adopt the same vision with you, it would allow the capital in your bank to grow much more quickly. Because if you think about it, it would be easier for my siblings to compile enough money for a nice vacation rental or an apartment complex together, share the profits, and allow the rents from our tenants to pay off the loan and increase the cash within our family bank, than it would be for me to fund it all by myself. Remember, this is all about applying velocity, leverage, and cash flow all at once. When all three of these are applied, your money will begin to snowball at a very fast rate. In closing, this lesson is all about education, and I know that watching this video clip may not be enough to fully grasp the concept. Remember, my purpose in educating others is not profit-driven, it's missional. I want to see the wealth go back to the people and to be taken away from the big banks. This is one way to accomplish this. So if you are not interested in talking to me about implementing this concept, please talk to someone else who understands it. If you can adopt the banking principles and stay disciplined, it could change your family's financial future for generations to come. I encourage you to question this lesson, disagree with it, and ask me or other qualified professionals you'd like about it. I know from experience that if your advisor doesn't understand it, they will negate its validity. But it's important to start your education now. If you're like me, you have to be concerned about the future of our economy right now. If there comes a day where the dollar gets to be in serious trouble of collapsing, you can always take your money out of your family banking system and invest in tangible assets. Then, as those tangible assets retain their value or increase in value as we wait until the dollar is either stabilized or the currency is restored, You will recapitalize your family banking system once again from your cash flow assets and continue to grow your wealth for yourselves and future generations.